Welcome to Talk Tickers.
Good to be here.
Today, we're taking a deep dive into Heidelberg's recent earnings conference call. We're looking at their fiscal year 2024-25 annual results.
Right. We've got the call transcripts, the presentation slides, all the source material.
Exactly. And the plan is to, unpack the key numbers, figure out what management's really saying, and try to get a sense of what's next, based just on what they shard.
Yeah, it's about getting past the surface level stuff. What's the real story behind these figures? What are the signals they're sending out?
Okay, let's jump right in then. Fiscal year 2024-25 headlines. Give us the snapshot.
So for the full year, I think the main thing that jumps out is the order intake. It showed some real strength, up 6.4% compared to the year before. So it went from about $2.28 billion to $2.43 billion.
That's right, $2.43 billion in orders. And you mentioned book-to-bill before we started. What did that look like? For anyone listening, that's orders coming in versus sales going out, basically.
Precisely. And with orders up that much, and sales actually down a bit, their book-to-bill was comfortably above 1.
Which is generally good news, right? Means the backlog is growing.
Exactly. They're booking more business than they're completing. They did make a point of saying this actually outperformed the wider German engineering sector, which apparently thought orders drop. So a bit of a positive divergence there.
That's interesting context. Orders strong, even against the trend. You said sales dipped slightly?
Yeah, just a bit. Net sales were down 4.6%, landing around $2.28 billion. So pretty much mirrored the previous year's order level, funnily enough.
Okay. And profitability, how did that shape up for the full year?
The adjusted EBITDA, that's kind of their core operating profit measure, hit $162 million, which works out to an adjusted EBITDA margin of 7.1% for the full 12 months.
7.1% margin. Okay. Now, I remember from the call, they made a point about cash flow, despite maybe some of the challenges.
They definitely did. Seemed like a key achievement for them. They managed a positive free cash flow of $51 million for the year.
And free cash flow is basically cash from operations after you've paid for necessary investments.
That's
right?
it. Yeah. And getting a positive number there, especially considering how the year started, was something they highlighted quite a bit.
And the overall financial health, the balance sheet?
Looks pretty sound, actually. Equity ratio ticked up slightly to 25.1%, a little more cushion there. And the net financial position improved too, now a positive $91 million. So more cash than debt on the books.
Got it.
They also mentioned they extended their revolving credit line, giving them a bit more flexibility financially.
Okay, so the headlines. Strong orders, sales down a touch, decent margin, positive free cash flow. But it wasn't a smooth ride all year, was it? They mentioned Q1 was tough.
Oh, absolutely not. The year started, frankly, quite poorly. Q1 saw a negative EBITDA margin and negative free cash flow.
Ouch.
Yeah. Management said it was largely down to the market being hesitant, waiting for the big Drupa trade show later in the year. But they really emphasized a clear turnaround starting in Q2.
And that coincided with the new management team taking over, didn't it?
It did, right around that time.
Okay, so what flipped the switch in Q2? What did the new team do differently?
Well, according to the call, the focus shifted sharply. They mentioned 3 main things: really hammering down on costs, driving efficiency measures through the operations, and crucially, getting much better at working through that big order backlog they had.
So producing more while spending less, essentially?
That seems to be the gist of it. Increasing output while tightening the belt.
And you could see that change reflected quarter by quarter.
You really could. They pointed to consistent growth in both sales and profit each quarter, starting from that Q2 turnaround. It built up through the year, culminating in Q4, where they hit a pretty impressive 10% adjusted EBITDA margin.
Wow, 10% in Q4 after starting negative in Q1. That's quite a swing.
It really shows that the operational changes had teeth as the year progressed.
You mentioned that positive free cash flow earlier, $51 million. How did they manage that turnaround specifically on the cash side?
Right, so 2 main things fed into that. One was the improving profitability we just talked about. More profit means more cash, generally.
Makes sense.
The other piece was really disciplined management of working capital. The money tied up in inventories, what customers owe them, what they owe suppliers.
Did they give any numbers on that working capital improvement? It sounds important.
They did. They actually reduced their net working capital by $17 million over the year.
Okay.
And they stressed this wasn't just a one-off. They showed a chart, I think, indicating that net working capital relative to their sales is now down to 17.6%, which is way down from almost 30% just 5 years back.
So they're needing less cash tied up just to run the business day to day.
Exactly. And that frees up a significant amount of cash, which was clearly vital for hitting that positive free cash flow number this year.
Okay, that connects the dots. Let's dig into the segments. Where did the strength and weakness lie in terms of products?
Well, packaging solutions is still clearly a major engine for them. Orders there hit a new record high, actually, up 7% to $1.27 billion. Strong demand.
Definitely. Sales in packaging were down just slightly to $1.18 billion, but the adjusted EBITDA margin held up well, around 9%, a slight improvement even year over year. So still very profitable.
And what about the print segment? That's kind of their traditional core, isn't it?
It is. Print also saw decent order growth, up 6.3% to $1.15 billion. They said this was mainly driven by demand for new machines.
But the sales picture was different.
Yeah. Net sales in print actually fell 4.1% to $1.1 billion. And again, they pointed to that market holding back investments ahead of the Drupa show as the main reason.
Okay.
And because the sales volume was lower, the adjusted EBITDA margin in print took a hit compared to the previous year.
Got it. What about the smaller technology segment? They sometimes talk about its future potential.
Technology sales were, let's say, moderate, but the key thing they highlighted there was a big improvement in its adjusted EBITDA margin compared to the year before.
So maybe not huge sales yet, but operationally getting healthier. That seems to be the message. Progress on the profitability front, even if the top line isn't booming yet.
Okay, product segment's clear.
Fairly.
How about geographically? Was it the same story everywhere?
Not really. Quite a mixed bag across regions. EMEA, that's Europe, Middle East, Africa, saw orders jump 10.3%. Pretty strong.
What drove that?
They mentioned good investment activity, especially in Italy, and also solid demand in Eastern Europe. But interestingly, net sales in EMEA actually declined 6.4%.
Huh. Orders up, sales down.
Yeah, it seems that weak Q1 hit Europe particularly hard, and the growth elsewhere in the region couldn't quite make up for it over the full year.
Okay. Asia Pacific.
Asia Pacific orders were stable, basically flat at $643 million. Management said there was a predictable dip in China in Q4, just before the big China print fair, as customers waited.
Makes sense.
But on the sales side, Asia Pacific actually grew by 7.4%, and that was strongly driven by packaging demand in the region.
Interesting. And the Americas?
America's orders were up 5.4%. They called out Mexico specifically, saying orders there surged 23%. Pretty impressive. But despite that, net sales in the Americas fell sharply, almost 40% down.
40%. Why such a big drop?
Seems it was mostly a hangover from that really weak start to the year in Q1 hitting the Americas hard, combined with just general reluctance to invest in that market through the year.
Right. You mentioned China print a couple of times. They seemed pretty upbeat about that event on the call.
Oh yeah, definitely. They framed it as a major success and a key driver of momentum going into this new fiscal year.
What were the results from the show?
They said they sold nearly 350 printing units, which apparently exceeded their own expectations. A lot of that demand was, again, in packaging, and they stressed this volume would keep their local factory in China very busy.
Any specific product news from China print?
Yes, a big one was the first sale of their new Jet 550 digital press into the Chinese market.
Ah, the digital side.
Exactly. Overall, they said they came away with a slightly triple-digit number of orders, combining firm deals and softer commitments from the show. They see it as proof their focus on packaging and digital is right and gives them a good launch pad for this year.
Okay, that's a perfect segue into the outlook. What are they forecasting for this current fiscal year, 2025-26, and what challenges did they flag?
So for this new year, they're projecting moderate sales growth. They expect net sales to nudge up from that $2.28 billion to about $2.35 billion.
Okay, slight increase.
Yes, but they made a point of contrasting this with the broader industry forecast. The VDMA, the German Engineering Association, is apparently predicting a decline for the sector. So Heidelberg believes they can buck that trend and grow.
That's confident. What about the margin?
They expect the adjusted EBITDA margin to improve further. From the 7.1% last year, they're targeting up to 8% this year.
8%?
Yeah, and they specifically stated this would be their highest profit margin since way back in 2008. So a significant target for them.
Reaching back quite a way there. What's supposed to drive that improvement? What are they counting on?
A few things. One, the momentum from that China print show we just discussed. Two, the continued positive effects from their ongoing strategic projects. And three, benefits from the personnel cost reduction measures they've put in place.
Right, the restructuring.
Exactly. They mentioned those measures are already showing results quickly.
Yep.
Remember, they booked that $25 million provision back in Q3 last year for future transformation costs related to this.
Did they give any hints about how this current quarter, Q1, is shaping up?
They did, actually. Some specific guidance for Q1. They're aiming for sales to be significantly higher than the weak Q1 last year, around 20% higher, they estimated.
20% up on last year's Q1. That's a strong start if they hit it.
Definitely. Although on the order side for Q1, they expect things to be stable compared to last year, but likely below the Q1 number from last year, which was exceptionally strong because customers apparently pulled orders forward before Drupa.
Okay, that makes sense. You mentioned the Jet 550 digital press sale in China. What's the overall status of that product rollout?
They said it's progressing right on schedule with their partner. They've got orders for 13 presses now, which they said is exactly what they'd planned for internally at this stage.
And machines are actually out there running.
Yes. First ones are delivered and operational at customer sites in Switzerland, Germany, and now China too, after that sale. So they feel the market seems to be validating the product as they'd hoped.
Good progress there. Let's circle back to the restructuring on the cost side, reducing headcount.
Yeah, the goal is to cut complexity and personnel costs, aiming for about 450 positions globally. They booked that $25 million provision in Q3 last year to cover the costs. Interestingly, they actually reduced that provision slightly by $4 million in Q4.
Why was that?
They said it was due to a change in assumptions. Apparently, a higher number of people are taking early retirement options than they initially expected, which changes the accounting slightly. But they still expect another $10 million or so in restructuring expenses to hit the books during this current fiscal year.
Okay. But the actual cash payments for that restructuring happen later.
That's right. The provision is booked now, but the cash will mostly go out the door in 2026 and 2027, according to the call.
Got it. What about the technology segment? You said the margin improved. What's the plan there going forward?
Yeah, they have a clear target for technology this year. Reach $60 million in sales, and crucially, make the segment profitable by the end of the year. Turn it into a positive contributor.
How are they planning to do that?
By leveraging their existing capabilities, like their foundry and electronics assembly, and moving more towards offering complete systems. They use the SAP e-mobility charging station project as an example of this shift. They even mentioned bringing in outside help to speed things up there.
Okay, sounds like lots of positive operational moves and clear targets. But surely there are challenges too. What did they flag as major headwinds?
A big one they spent some time on is taxes. It's a bit complicated. Even as the overall company gets more profitable, they're still facing relatively high tax payments.
How does that work? More profit usually means more tax, but why relatively high?
It's because of where the profits are being made. They're generating good profits in China, where they pay local taxes, but they still have losses, at least on paper, in their German entities.
So the German cost-cutting hasn't fully fixed the profitability picture in Germany itself yet.
Apparently not enough to offset the China profits from a group tax perspective. And while they're cutting costs in Germany, they're also strategically increasing the value add and production capabilities in China, which, kind of works against improving the German profit share in the short term.
So it's a structural issue linked to their global setup.
Yes, exactly. They said they have a larger project underway to get the German side more sustainable. But for now, during this planning period, they expect their overall effective tax rate to stay pretty high until they can achieve what they call the breakthrough in their internal structure. It's clearly a persistent headache.
Okay, that's a key challenge. Finally, what about free cash flow for this coming year? It was positive last year.
Right. This is another area where they kind of managed expectations a bit. While they did generate that $51 million last year, they expect CapEx, capital spending on things like new equipment, facilities, to be higher this year.
And higher CapEx usually eats into free cash flow, doesn't it?
It does. They were pretty clear they're doing this intentionally, reinvesting the cash they generated to fuel growth. They specifically mentioned digital and large format products needing investment.
So investing for the future, but it means less cash in the bank this year.
Pretty much. They expect free cash flow to be lower than the $51 million they just reported. They're still aiming for it to be positive, just less positive. And don't forget, those restructuring cash payouts we mentioned, while booked now, the actual cash outflow hits mainly in 2026 and 2027, which will also be a drag on free cash flow in those future years.
Right, okay. We've covered a lot, the results, the drivers, segments, regions, the outlook, strategy, and those key challenges. Now, let's get to that part of the show. the brainstorming bit, purely for informational fun, naturally.
Ah, yes, the disclaimer zone. Let us state very clearly this is not financial advice. Please, nobody should be making investment decisions based on what we're about to speculate on.
Absolutely. Not financial advice, but just processing all this. You've got the strong China momentum, the clear push into packaging and digital, that bullish Q1 sales forecast, but then you've got the heavy CapEx needed, the tax complexities, future restructuring, cash drains. If you had to concoct an outrageous but maybe plausible trade idea just based on the narrative from this call, what comes to mind?
Okay, purely theoretical exercise here. Based only on what they laid out, you could, perhaps, think about a trade focusing on the short-term story. Betting on that Q1 performance, they guided towards that 20% sales jump off a low base, could really leverage operations and maybe surprise people when the results come out.
So like a bullish near-term play, maybe call options.
Something like that, perhaps timed around the Q1 earnings release.
Yeah.
But here's the outrageous twist. You might simultaneously hedge that, or even take a separate, longer-term view that acknowledges the costs and challenges.
Hedging against what exactly?
Against the execution risk and a cash drain. The CapEx needed for digital and large format isn't trivial. The tax issue isn't going away overnight. Those restructuring payouts will hit cash flow later. So maybe the hedge involves longer-dated put options, anticipating that these medium-term pressures could weigh on the stock after any potential Q1 pop.
Or maybe even shorting a competitor.
Well, that's another angle, maybe riskier. The idea could be that Heidelberg is at least trying to make the necessary, albeit costly investments, while maybe a less agile competitor isn't, but still faces market headwinds. So Heidelberg might outperform relatively, but the absolute cost burden is still significant.
So you're essentially betting on the near-term operational momentum they described, but acknowledging and hedging against the very real investment hurdles and cash demands they also mentioned for the medium term.
Exactly. It tries to capture that inherent tension in their story. Deliver profits now via cost control, but spend big for future growth. It's definitely aggressive, hinges completely on their execution, market uptake of new products. Lots of ifs. And again, just a thought experiment, absolutely not a recommendation.
Definitely food for thought on the dynamics at play. Okay, let's wrap up this deep dive on Heidelberg's fiscal 2024-25 results. What are the key takeaways?
Well, they certainly showed resilience, pulled off a significant operational turnaround during the year, especially from Q2 onwards under new management. And crucially, that translated into positive free cash flow, which was a big goal.
Right. And they've laid out a clear strategy focusing on packaging and digital, boosted by recent wins like at China Print. They're forecasting growth and aiming for that highest margin since 2008 this year.
But, and it's important, but, they were also upfront that delivering on that growth strategy needs significant investment. The CapEx will dampen free cash flow this year compared to last.
And they still have those structural challenges like the complex tax situation tied to their global footprint hanging over them.
Exactly. So it really leaves you thinking about that balancing act, doesn't it?
It does. How do you manage the pressure to deliver profitability right now through efficiency and cost control, while at the same time knowing you need to pour substantial cash into building the next phase of the business? What does that tension mean for them over the next couple of years? Definitely something to keep an eye on based on this call.